Hello friends, welcome to IGCSE Accounting tutorial. If you are new to this channel, please subscribe the channel and press the bell icon so that you can receive notifications about my latest videos. Today we are going to solve January 2017 question number 15. Let's start. Number 15, option A, explain the difference between writing off a bad debt and making a provision for doubtful debts. The first one is bad debt is written off when it is confirmed that a specific value of debtors is not going to be collected, and a provision for doubtful debts is made when there is an assumption that a part of the debtors will not pay back or some part of the total value of debtors will be collected. The next one is this amount is charged as expenditure in profit and loss account. Here the increase in provision for doubtful debts will be charged as expenditure and decrease will be recorded as operating income in the profit and loss account. And the last one is this figure will be deducted from the receivables ledger or sales ledger control account, and the total provision is deducted from the debtors figure in the balance sheet under current assets. Clear? Next. Option B, state which accounting concept is being applied when creating a provision for doubtful debts. First of all, let us understand what is a prudence concept. Under the prudence concept, do not overestimate the amount of revenues recognized or underestimate the amount of expenses. You should always be careful in recording the amount of assets and not underestimate liabilities. Clear? And the answer of this question is the provision for bad and doubtful debts is reported in the receivables section of current assets and is deducted from the final figure of debtors or receivables. The provision does not show the debtors that have resulted as bad debts. Rather, it shows the debtors that may end up as bad debts based on past experience. And ultimately, company may not recover money from these debtors. These debtors are included in the provision under prudence concept of accounting. Clear? Next. On 1st July 2016, Kao was advised that Mayo, a debtor, had ceased trading, owing them £580. Kao decides to write this off as a bad debt. Option C, prepare the journal entry to record this write-off. A narrative is not required. So to record this write-off, bad debts will be debited £580 and receivables or sales ledger control account or Mayo will be credited £580 on 1st July 2016. Clear? Next. On 31st August 2016, Kao receives a check for £275 from Mayo in payment of the debt that had been written off on 1st July 2016. Option D, prepare the bad debts recovered account to record this transaction. Show the transfer to the financial statements at the year end of 31st December 2016. In this question, there will be two journals. First one will be to record the bad debts recovered transaction, and the second one will be transferring the bad debts recovered to profit and loss. So, to record bad debts recovered, the journal will be bank account debit £275 and bad debts recovered account credit £275 on 31st August 2016. And then to transfer this amount to profit and loss, the journal will be bad debts recovered account debit £275 and profit and loss account credit £275 on 31st December 2016. And in this question, we will be just preparing the bad debts recovered account. So in the bad debts recovered account, on the credit side, we have recorded the bad debts recovered £275 on 31st August 2016. And on 31st December 2016, we are transferring it to profit and loss, £275. Both of them are explained below. Clear? If you have any query regarding this question, please comment in my comment box. I will try my best to explain you. If you like my video, please share with your friends and family, like my Facebook page, subscribe my YouTube channel, and don't forget to press the bell icon so that you can receive notifications about my latest videos. Thanks for watching. Bye bye.